Okay, so before I say or predict where I think my idea of rates are going, probability wise, some of you have responded back when I've set these videos out and asked, how do I get these lines? Where do they come from? So where I get it from is we're going to take our best time of interest rates, which was back in 2020, best time ever actually in history, and then we're going to go to our worst point. And so if we start off at the very top and we get to the very lowest point, come on, there we go. Then we're going to have an idea of where our next ceilings and of resistance and our supports are going to come into play. Now I'm going to go ahead and just zoom in real quick to make sure I got this perfectly right at where it needs to go. And I'm going to do the same thing for the lowest. And that should give us our exact coordinates for really our next low and our next high. Okay, so sure enough, what does that do? Well, it gives us a ceiling that we are going to face as a resistance. And what's happening? We are trying to get above it and we get rejected. We're trying to get above it and we get rejected. Now, there's good news and bad news. Bad news, obviously, you're getting rejected consistently. That's not a good thing. And yes, that could lead to a probability that you're going to actually get it fall worse or it's going to decline even more. However, it also could mean that, you're building support right here to overcome that ceiling. And so when you do overcome the ceiling after getting rejected this many times, that could signal that you have a large rally coming, very large, significant large. Now, the other thing that's happening is we're getting stuck into a triangle, and a triangle it ends in one way, catastrophic rally or decline. And how do we know when that's going to happen? When do we get out of the triangle per se? So what we are going to do, we're going to take our highest high and we're going to draw essentially where we can get to the current day, but we're not going below any of the previous highs. So essentially when I put that line there, I'm going to go out a little bit farther too. I'm going to put that there. So basically, this line now shows, and nothing is getting above it. Nothing's essentially overthrowing it. I went a little too high there. I'm just going to bring it down just a tad. Okay. Now we're going to do the same thing on the bottom of it. We'll go to our lowest low, and the same thing. I want to go until I don't run into any other line. About right there is going to be where it goes. So at some point here in the next couple of days, we are going to go back and forth until we get to the decision point. So we're going to go here, 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 and until we get to that point. And it could happen before. It doesn't have to go all the way into that the end of the triangle. However, it typically does, but it doesn't have to go that far. It can make a decision which direction it wants to go, and it usually happens kind of right around this area. I don't think we're going to see anything, next week. I would hope not, at least, that will make us fall out of it. But I think we'll probably see it sometime. Really, it's looking about May or June. Keep in mind what comes out at that point is going to be the CPI report that the Fed Treasurer or U.S. Federal Treasury has been saying. It's going to be the decision-making point of where rates are going to go. Now, here's the good or bad news. Just depends how it goes. We can take the measurement of this, which is going to be from here to here, and we're going to take that. I'm going to put it right on. We're essentially, if it broke out here, then it would be really this. If the bond market crashed that much, I think we'd have bigger problems to worry about than really anything. But that result is almost too improbable for me to think that's going to happen. However, if it goes the other way and goes to the very top, ironically, you're going to find it's going to be at probably one of these red lines. But the other part of it too is we've been there before, so it's a lot easier to get somewhere there where you've been before. We have been at that point in the past, but we've have a lot more currency in supply, money in supply, because we've printed it. So to get back to that low point back then, when we were trillions less in debt, almost 20 trillion, half the debt was back then. or we had half as less debt than we do currently back then, it's almost impossible mathematically to get back to that point in theory. However, if we take this and we go where this point was right here, sure enough, we get right above those two. And if we take this down until we're getting to the point where we're going to breach it, it'd be right there. So sure enough, at the end of and they call it a vortex, when you're at the end of the vortex of where this is going to break one way or the other, that gets you right to your point of where you're going to be getting to a ceiling. And these two lines are actually very important. They're very important because if you notice in the history, so that first one, here, those are points that have been ceilings in the past. Usually also when there's two of them like that right there, it's really called the golden spot. There's a mathematical term for it, but the point is that if you're able to break it and if you're able to maintain it, then you usually have a really good rally after that. And sure enough, last time, huge rally. Could happen again. We'll see. But nonetheless, I would say that rates will probably get better for this significant amount. If we go to the upside, it could go to the downside. However, we will all see what the market looks like at that point because none of us have ever seen it, no matter how long we've been in the business. But odds are better than not. Hope this makes sense. And reach out and ask questions like you have in the past if you do.